Thank you, everybody, for joining us this morning. I'd like to start by just touching base on a couple of the items we have on our news bulletin, and obviously news overnight, essentially. One thing, Carol, if I can go to you first on this, on Iran. You know, we've had a few weeks now of talks in Vienna through third parties between the US and Iran, and there was a sort of a momentum at one point ahead of the Iranian elections that this is going somewhere sooner than expected. Then we had the elections last week, and the assumption that things may slow down now with the new government in place. However, this article seems to highlight, at least Iran is saying that a deal is being made and we've got our oil sanctions lifted. So who are we to believe, and has anything really shifted this week?
Good morning, Diana. Good morning, everyone. I mean, look, I would be very suspicious of these kind of statements, because unless you hear an official statement coming from all parties, we will continue to be in this kind of yes and no position that we've been witnessing for the last few months. And anyway, it was naive to really believe that an agreement or a deal would be reached before the Iranian elections. And now that you have a new president in office, it's not going to happen overnight, because you may have a different agenda. And of course, at the end, it's just what the supreme leader wants. And so far, the supreme leader is endorsing the negotiations and a deal. But whether this happens overnight and whether it's coming only from the Iranian side, I would remain cautious, because it has to come from all parties. It's not something that we heard from various parties. Of course, President Biden has to show to the rest of the world, and particularly to his own audience back at home, that he's getting something in return from that deal. Otherwise, he's going to face more opposition back home. So it's not going to be really a smooth ride as people expected, but hopefully we'll get there, because at the end, the Iranians want to reach a deal. I mean, they have been struggling. First of all, they had the double whammy of low oil prices, tighter economic conditions, really dire economic conditions to be more accurate. And then add to that the fighting of coronavirus. Of course, they can go on and on and on, as we saw as many regimes around the world, but a deal would have been definitely much more beneficial for the Iran. Whether it happens tomorrow, I doubt it's going to take a little bit longer for a deal to be reached.
Ole, in terms of the Iran deal, I mean, the market up so far really has now essentially either accounted for any Iranian oil that might come through, but also, is it correct to assume that it's making the assumption now, as Carol was saying, regardless of daily changes and statements, that really we're not going to see Iranian oil to the end of this year? Is that a given, do you think?
Well, I think the way the market has been behaving this past couple of weeks, where we've seen the news ebb and flow from the talks, that the market is at this stage not really taking any additional barrels into account from Iran. And the question is obviously when they get when the deal is reached, how would they impact the market? Will they unleash barrels into the market? Because obviously they got the world's biggest fleet. They got the millions of barrels stored on and offshore, which can be released into the market. So it may create a short-term blip to the downside in the market, but generally OPEC right now really got the market pretty well tied up, because we just seen another weekly data from the US. Even though record earnings are expected in the US shale patch, we're not seeing any increase in production. So OPEC really has got this market sewn up for now, and any release from Iran, I think, probably will only have a short-term impact on the price.
I mean, you mentioned shale, and I'd like to get onto that a bit later. We had a few comments yesterday from our panelists, which were looking more positive for shale, actually, but we'll get onto that. But in terms of OPEC, obviously they meet in a week's time. What are your expectations, Ole, on what they will do? I mean, we had a statement from the Saudi oil minister last night saying that, yes, we're aware of these inflationary concerns and we will act if we need to in terms of oil price impact on that. But yet, the word cautious remains to be the label on Saudi Arabia, really, in every sense. What's your expectations on what they might do for August onwards?
Well, I think for the first time in this whole cycle, we have OPEC has a really important role to signal, because we can see demand is picking up. Yes, we still got some virus worries in certain pockets, but generally demand is picking up, and that basically means the world is going to require more oil over the coming months. As mentioned, so far this is not coming from non-OPEC sources. Shale growth is still lacking. So but the signal they send next week is really very crucial, because they will either tell the market that they're looking for price stability or they're looking for even higher prices. So I think that given the sentiment in the market right now, they can easily they will have to increase production. Whether it's going to be 500,000 or 1 million, that remains to be seen. But I think the signal value in next week's meeting is going to be quite significant, because we got right now. If I look across the commodity space, we're seeing a rotation out of metals and agriculture into energy, and that's obviously in the belief that OPEC Plus will keep supplies tight, demand will continue to go up, and that will ensure prices will continue to rise over the coming months. OPEC obviously holds the key as to whether that's going to happen or not.
Okay, thanks, Ole. Vitali, welcome. I mean, Ole just mentioned about OPEC obviously holding the key, or holding the power on what it does with supply. And shale, Ole was saying, is still not back. I mean, we had somebody on our panel yesterday saying this week we expect US production to hit 11.5, which is a bit higher than it has been. And so we are seeing that tighter oil arguably start to creep in. How much of a is OPEC, I know, dismissing shale still for the time being, and or is it a keeping an eye on that? And what's your opinion on whether shale can really continue to stay out of the game at $75?
Yes, hello everyone. Indeed, this is the key question. OPEC seems to be in the driver's seat, while the shale more and more looks like a giant on clay feet for the moment. And everyone is wondering why US producers are not striking back. And I think it really has to do with the way the shale operations are organized. It's the so-called Red Queen effect. They need to run ever faster just to make themselves capable of producing the same amount of oil. And the amount of drilling that has not taken place because of the pandemic and all delays and skepticism about the future of oil in general, globally and in the US, gave investors a pause and gave the producers a different rationale. Because before they could really make their case before the investors saying, well, we are just good industry, bringing you normal returns over the long time period. Now they have to demonstrate very high returns to convince the new generation of investors that this industry that many call the dying industry, the industry of the past, is still interesting financially. And therefore, yeah.
Sorry. Yes, Carol.
And in this sense, it's a different ball game. The U.S. producers, they probably want to demonstrate very good financial results, and they will surely will for 2021. But this comes at expense of low production volumes, production restraints.
Yeah, I mean, we have. There's another story on the bulletin today with that record cash flow for public E&P companies. Obviously, not all of them are in tight oil or shale, but a lot of them are. Carol, on the point of shale, again, I mean, what we had that survey question come up from yesterday's results. At what point will shale producers have to get back into the game? We're already at 75. The projections are oil prices are going to be continuing to go up. There may be some volatility, but we are on an upward trajectory. So if you look at that survey that we had yesterday, the majority of our audience believe that this is the price range at which they're going to come back in. And if prices are increasing, that's inevitable. The companies that own these companies now also are doing much better and having a much better year. So you've been generally quite cautious about shale coming back. Are you still as convinced?
No, actually, I used to be, and I'm still quite, optimistic about shale, simply because the massive resource is there. So it's not a question of the resources are not there, and even the extraction cost, the development cost, can generate significant profit at current prices, and that's exactly what we are seeing. But there is here perhaps a shift in strategy that we are seeing, and it depends on the time frame we are considering. So of course, immediately we're not going to see a miracle happening, because this has not happened over the last few months. But people are more talking about a return. But at the end, the return is the wrong word, because shale is still there. Yes, we had this peak of 13 million barrels a day, but even at today's levels of production, the US remains the biggest producer in the world and has taken market share from other producers, including from OPEC itself. So we should put everything into perspective. The same thing when we talk about prices, oil prices. In my opinion, it's a mistake to simply zoom in on what's happening in oil markets, because if you look, let me look at only energy commodities by themselves, we can see that there is a sugar rush everywhere. So gas prices, TTF in Europe, seasonal high perhaps since 2008, if I'm not mistaken. Thermal coal is also recording record prices compared to previous seasons. So there is a kind of a massive recovery happening, and with it a sweeping oil market supported by OPEC strategy. So to go back to your question about shale, I mean, these are private entrepreneurs, and they are guided by, making money, making profit. They may be cautious today because they want to convince investors and financial backers that they are not the wild explorers that we saw at the beginning of the shale revolution, that they are more disciplined today, but sooner or later they will have to react. And already, if you look at the most recent survey published by the Federal Reserve Bank of Dallas, that there is a very strong optimism sweeping the industry in the US and greater activity. However, they highlight the point which I mentioned here on this. They started to talk about cost inflation. And usually there is this kind of relationship between prices, oil prices, and cost, both capital expenditures and operating expenditures, with a time lag of maybe 6 to 9 months, a little bit higher, depending on whether you're talking about deep water or expensive opportunities. And as prices recovered, they recovered very fast. And everywhere you have this kind of upward pressure on inputs, on materials, then investors and producers on the oil industry will start to feel the impact on cost. And to go back in time, in 2013, when prices were hovering around $110 a barrel. I forgot the CEO of a major oil company, but he said something that illustrates exactly what happens on the ground, that $100 for the market is equivalent to $20 for the industry. So it's not, a straightforward path where you say high prices, investment will go, and therefore supply would go. It's much more complicated for that. And on that, I would add, high prices are always bad news for the industry in the longer term if they're sustainably high, because they will attract the taxman, and we will see, time will prove that.
The taxman, and also the impact on emerging economies, obviously. And then we've already seen OPEC face some criticism. It's seen as control of the market at the moment. So, consumers like India have said, at $60, they're already complaining, and now we're nearly at 80. Do you feel that, a lot of argument has been made recently that, well, OPEC has to make the most of these prices because it's had a bad year last year, etc. But what concern is there for these emerging economies and the impact on them? We had the Saudi minister yesterday saying, we will keep an eye on these prices, and they have the power to temper them. Do you really think that that OPEC will do that? If we continue to see 80, 90, we're going towards $100. Will Saudi step in as a leader and keep those prices under control?
So you have overall the OPEC Plus group, and you have, I would say, the Saudi view, which I would say has been pretty consistent for the last few decades, whereby they have been acting responsibly, because yes, they would like to see prices higher. Which producer doesn't like to see that? But at the same time, they realize that high prices are not ideal, especially under today's economic conditions, because mind you, we're not over with COVID-19. People are already warning of the Delta variant spreading faster. In the UK yesterday, I was watching the news, they were already predicting a fourth wave for the autumn, and on top of that, the flu, that might hit us stronger than before. So the recovery is still fragile, and many economies, usually talk about the pre-COVID levels for the richer economies. China, yes, is ahead of the game. The US and some European countries may by the end of this year, they would go back to pre-COVID GDP levels, growth rates, but for other countries, they are still far behind. They will take another maybe 2 or 3 years to catch up with the pre-COVID-19 levels. So taking that into consideration, and especially for oil importers, for them, that would be an increase in prices, an increase in commodity prices, that would definitely impact negatively their economy. And this is where the Saudis are coming from, that they don't want to kill the goose that lays the golden egg. And this has been for their strategy for many years, and they're not going to shift it today in this delicate and critical moment of economic recovery.
So the expectation is they would intervene with some action at some point. I'd like to bring up our survey because I want to move on to demand a bit. We talked about supply and we talked about Iran and shale. Just again, to kind of look at the demand equation as we always do. And there's our survey question for the day as we enter the second half of the year, which is going to kind of weigh on demand sentiment more. And there you have the yin and yang, you have the stock draws, which are obviously showing positive demand at the moment, at least. And then we have what Carol just mentioned, this resurgent COVID-19 waves. And then another positive, which is the infrastructure spending plans. So if everyone can cast their vote on that, which of those weighs more on sort of market sentiment in terms of on demand? Oli, I'd like to go to you on that point, on the demand factor. Commodities, as we know, have been rising for a few months now on the back of resurgent demand and spending plans, big infrastructure spending plans by the US and more coming. And China, of course, continues to spend on that front in terms of the two biggest economies in the world. How much support is that giving to? Is that all we need really for the demand equation? And regardless of COVID or any other negative impact, that's enough to keep these prices up and to keep commodities running.
Well, at least in the short term it is, because that's the main driver right now. When we move into 22, 23, I think
infrastructure is a long term. The infrastructure plans are years and years of planning.
That's true. That will require an immense amount of energy and also the so-called green metals, and that's really the whole conundrum that we're facing. We're facing investors who are basically want to invest as if we were in 2030 already. They want to move away from carbon intensive industries, so they are restricted in mining. They're restricted in buying into oil companies, and we just have to accept the fact that we are going to rely on carbon for carbon heavy of fuel for a number of years into the future, and that basically leaves us with a mismatch, which is going to start to play out once the OPEC has added the barrels that it took away. Once that back into the market, then that's really when the focus is starting to move back to some of these producers, whether they will be able to increase production and thereby keep the market stable, and that's obviously where the whole speculation now is coming with the renewed talk about $100 going into the future. It's not because demand is going to accelerate much beyond the peak we saw back in 2019. It's more where the additional barrels going to come from, because also I think OPEC's got X amount of barrels that they can still add into the market, but some of these barrels needs to be tried out. We got Angola and Nigeria, Iraq. How much of the production cut they implemented, how much of that can be reinstated? But if I just have a quick comment as well, just to finish off the shale industry, because what we have to remember as well, we have a very, 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 very steep backwardated curve right now. We have high spot prices. We have decreased prices further out the curve. This is a bonanza for OPEC producers who they are selling in the spot market. OPEC, shale oil producers, they need the forward price to be high as well, because they need to look into the future. They need to sort out their financing. Right now, 2 years out, WTI is still trading around $60, $12 below current levels. As long as we have this very steep situation, that is obviously that's potentially keeping US shale growth down, while it's obviously adding a major boost to those producers who are selling, relying on the spot price.
Vitaly, on that point of supply, really, and having enough supply to meet this demand that's coming up, OPEC is in control at the moment. It's a backwardated market. But in terms of, do we have, the OPEC has obviously spare capacity still to put back in the next year or two as demand grows. But your opinion on the tightness of supply, if you like, and if it's a concern for the market.
Well, first of all, I fully agree with Ola. The time structure of the market is really just a great thing for OPEC Plus. In fact, it's good that you asked that question, because I've received several inquiries from reporters in a few past days asking what spare capacity Russia has, whether Russia's ability to add incremental volumes to the market have been affected by long idling of the wells, and whether it would damage them. People are really asking those questions. With regards to the big players, obviously, the Saudis do have spare capacity and they can add additional volumes to the market. Russia, I think, can return back to its pre-crisis levels of output without significant additional investment. So it's, the performance of the wells suggests that generally there wasn't big damage done, because Russia is different. A lot of operations have to be performed in extreme weather conditions, extreme cold conditions. So there's a big potential for damage in the wells, especially since Russia is using water flooding to such an extent as a production technique. Well, I think going back to the start of our discussion, I think it's very interesting to look at the sanctions and a possible return of Iranian volumes to the market, because in fact people zoom in on OPEC, saying that, well, it has the power to bring prices down, but arguably US also has power to bring prices down if it wants to, by removing the sanctions. And the question, what are they going to get back in return? Well, it's quite simple. They may get back in return low prices. But obviously, people would wonder whether this would have long-lasting effects and whether this is whether this trade-off is worth the effort. But it's a separate discussion altogether.
Yeah, has Russia, I mean, in terms of, now we've reached the $75 mark and we're steady above 70 for quite a few weeks now. Russia, in recent months, has been making the argument as part of the OPEC Plus group that, we need to bring more of our oil back to the market at some point. We need to retain our market share. We can't risk shale coming back. Is that argument still as strong from the Russian point of view with these nice prices? I mean, do they really care about bringing more oil back, or are they happy where things are? Let's keep the ship steady.
Well, I guess the answer is more complex than a simple yes or no. Russia's federal budget is balanced on the Urals price of $43 per barrel. So everything above that level brings tremendous amount of additional windfall revenues to the state budget. So for the Ministry of Finance has been extremely happy. Russia's oil companies, and Rosneft especially, they have been making the argument you just made, that we need to produce more, not to give up our market share to high cost producers. And I think that that's an important argument in the debate. In the end, I think it will be a balanced decision for Russia at large, taking into account both positions.
Okay, I'd like to bring up the survey results of the question we put up a few minutes ago, just to have a look at that. Okay, so it seems that the sort of negative sentiment is weighing on the market most, i.e. the COVID blip, just about blips, the stock draw and infrastructure spending plans, which are, I suppose, more medium term, aren't taking such a big, so 45 against 41. Very slight difference there, but nevertheless, obviously some concern then still on the COVID waves. I'd like to now sort of look forward to the week ahead and ask our panelists what we should be looking out for. Carol, I'll go to you. Anything on obviously we have the OPEC meeting at the end of next week, but putting that aside, any other factors to watch out for as we sort of end the month of June?
Yeah, there's lots of economic data coming out, particularly from the US, and I think later today from the UK as well, central bank decision on interest rate, if I'm not mistaken. So all these, because at the end, remember, this was a demand-led shock, and it was not just the demand when I talk about the oil demand, but the global economic growth, which was hit badly by coronavirus. That's why when I want to think about the oil demand outlook, I cannot but look at the economic outlook, the growth forecast, the fact that whether it's just a rebound or a serious recovery. When do we go back to pre-COVID levels, growth levels, and whether they would be sustained or not. So these are that's why for me, I would my main interest these days is to look at the economic data to see whether that recovery really has strong teeth, or is it just going to be a temporary, and then we're going to face a slowdown towards the end of the year. Hopefully not, but economic data is interesting to watch for by the end in the next few days.
And what do you make of the Fed's sort of slight retraction earlier this week on its stance last week regarding interest rate plans? It didn't reverse that, but it did say, don't worry, everyone, we're not going to do anything with interest rates until we see real inflation. But arguably, we're seeing inflation today already. We're seeing the consumer price indices go up, arguably maybe because of bottlenecks, but demand is coming back. So we talked a lot about this last week, but again, your views on that in terms of from the Fed's point of view and how oil markets are reacting to that.
Yeah, you mentioned inflation, but mind you, even the central banks and the Federal Reserve Bank in the US, they talk about a temporary increase in prices, ironically including energy prices. So they see them as a temporary reaction to all the money that has been injected in the economy, the rebound from a deep hole because of coronavirus. And their chairman, another chairman, actually another representative from the central bank, Federal Reserve, they use an expression that you used earlier, which is keep the boat steady. So they did not change their position from last week, but they tried to reassure the market that it's too early to really commit to an increase in the interest rates because the market became volatile following last week's meeting. But this week they are saying, actually in the last few days, they kept on using expressions that we're not going to take any preemptive measure. We want to see serious evidence before taking any action. And this is what they are trying to do to reassure the market that the rates are not going to increase quite rapidly without seeing strong evidence that the economy is seriously recovering. We're getting towards full employment, and inflation is causing a serious structural risk, permanent risk, than what we have today, temporary.
And of course, one of the signs of the economy growing, I suppose, and people being back to business, if you like, is travel, not just tourism travel, but business travel, etc. I'd just like to touch on that before we end and go to both Ole and Vitaly on that in terms of, Ole, first to you, jet fuel demand has been a big part of, a factor of, sign for real recovery, obviously, and especially in terms of oil products markets. Product markets have obviously been lagging behind crude recently. There's a bit of a duality there, and jet fuel makes up obviously a lot of that. We saw China close its borders yesterday, an announcement that it's going to be closed for another year or so. But in terms of European jet recovery for Europeans, for Europe, whether it's inter-Europe travel or Europe to the States, where do you see that going in the second half of the year? There were hopes that it would get a big boost by the summer and onwards, but bit of caution there?
Well, I think your poll just tells us that the market people are cautious, and if that's the theme that or the caution, that we take that with us into the second half, then the recovery in jet fuel is really going to be the laggard, the one that prevents demand from returning to pre-COVID levels. So it really, we're going to see a strong signal this summer as to how travel resumes. I'm sure into Europe there's going to be a very, very strong pickup, just like we've seen into US and into China. But intercontinental, the long haul flights, I think that's really where we're going to see some of the lagging effects. And one of the reasons why, again, it's IEA is probably right in saying that we are not returning to pre-COVID levels until late 2022, when we hopefully have by this time have much more vaccine rolled out and we got the virus more under control than we have right now.
Vitaly, you'll have the last word. Anything in the week ahead? And again, on the jet fuel market, obviously there's strong travel within Russia as well. I mean, as Oli just said, intra there is, but week ahead outlook, anything to look out for, and your jet fuel outlook for the next 6 months. Oh, we've lost you. You're on mute. Yes, thank you.
Yeah. Oh, sorry about that. I fully agree with Ola. Yes, I think we are seeing the regionalization of air travel within individual countries and within regions, and cross-Atlantic travel, cross-Pacific air travel, and basically, yeah, they will be coming back much later to the pre-crisis levels. In terms of interesting developments, I would like to mention briefly gas markets. Here, the European gas market, Carlo already mentioned a very tight situation there. What is important, I think, is that in terms of relative prices, not just absolute levels of very high absolute levels of prices we are seeing both in the oil market and in the gas market. In terms of relative prices, gas prices are extremely high relative to oil now, and in Europe, it's driven by extremely tight situation with gas and storage, very low levels of gas and storage. on the back of cold winter, and now on the back of very warm summer, because people are using air conditioning much more than they used to. And this puts an interesting dilemma in front of the US again. Nord Stream 1 is in operation, and gas volumes flowing through the pipeline basically much higher than the nominal capacity. Now we have the first string of Nord Stream 2 in place and ready for final testing and filling out. And now it's again the sanctions, whether US is going to lift its opposition. It already indicated that it would, but we are still looking at the certification of the pipeline, which pretty much rests with the German authority, and the negotiations between the Germans and the Americans are still taking place. But it's a choice whether you want to have a lower gas prices in Europe, or whether you want to have your sanctions in place, which are not really helpful to your relations with Germany. I mean, for the US. And which are not helping the European consumers, because they are really looking at extremely high gas bills as a result of the US sanctions. So
yeah, of course,
the US can really release the opposition and help Europe.
The fun and games of geopolitics there. We won't get into that one. Well, thank you very much, Vitaly Yermakov from the Oxford Institute for Energy Studies, Dr. Karol Nechle, CEO of Crystal Energy, and Ole Hansen from Saxo Bank. Thanks very much for joining us today, and have a great weekend.
Thank you.
Bye-bye.